Option trading for beginners from the ground up. Yeah, so obviously in a broker, we don't need to go through that. Options versus stocks. So leverage. It's like why not just be using stocks? People always kind of have that question, whatever. Options trading allows you to control a large amount of stock with a relatively small investment, which can magnify your potential returns. So that's what's attractive about it. And then
Yeah.
there's limited risk. When buying options, your potential loss is limited to the premium paid for the option, which can provide a measure of protection compared to trading stocks outright. For example, whenever you're buying an option, you might be able to buy that option for $100, $200, $300. To be able to trade something like a Tesla, something like an Apple,
Yeah.
let's say Tesla trading around $400 just to buy one share of Tesla, that's going to cost you $400. And for you to even make, let's say, even $10 on Tesla, it's got to go up $10 to $410. And then you only make $10 off of a $400 investment. That's
Yeah.
not very attractive. But with options, if you use $400, you have the ability to make a lot more than if you were to, use stocks with that money. You know what I mean? So,
Yeah. Real quick,
what are go
group
ahead, go
said,
ahead.
"Let go, Uncle Jerome." Oh,
Let
see,
go, Uncle Jerome. Oh yeah. They
100%.
another name is Daddy Gray Hairs. That's what they be
I haven't
saying.
heard that one. I'm not gonna lie to you.
Yeah.
Me,
Man, my thing logged me out, and I gotta log back in. I'm not good with that password stuff. Anyways, I'll log back in here in a second. Anyways, what are options? Options are like insurance for shares of stock. Many investors will buy options to hedge their risk in the case of a big move in the market. We talked about this a little bit on the last stream on Monday, how I was saying initially they were kind of used as insurance, and people will typically start to buy options whenever there's a potential big move in the market coming,
yeah,
which is something like FOMC day today with the rate hike decision, or earnings being after hours at the end of the day. Like, again, people will start to buy these things for when a big decision in the market is coming and they don't know how the market's going to react. And
yeah,
that's when option buying will typically pick up. Um, anyways, but in this series, we're primarily going to focus on trading the price fluctuations of the option contracts and what affects their price. So yeah, you can buy options as insurance on your shares, but what we're doing as traders is we
yeah,
like to try and trade those price fluctuations of the option contracts themselves. Yeah, you can use them for this as insurance on your shares, but we like price movement, and we're not trading the stock price movement, but we're going to be trading the fluctuations of the options price themselves. So how to trade options. Options allow you to choose what price level you think a stock will go to or not go to within a specific time frame of your choosing, right? So I said price level and specific time frame. That price level that you choose that you think it's going to go to or not go to is called the strike price. So
yeah,
you'll hear this terminology used and thrown around a lot, like, oh, I'm gonna short Apple. I'm gonna sell options on Apple. People be like, okay, like what strike price are you selling? Like, let's say Apple's sitting at 450. You might be like, I sold the 460 strike. So then
yeah,
you will know, okay, they sold the options at 460, that price level that they don't think Apple will go to, or they think it'll stay beneath. And then I said within a specific time frame, that will mean your expiration date. So it's like, okay, I think Apple is gonna stay below 460 by next week. Then that is essentially saying I'm gonna sell the that means I sold contracts above 450, and the contracts that I sold is going to expire next week, and that's
yeah,
that specific time frame. So we get to choose our strike price and we get to choose our expiration date. We get to choose our price level, we get to choose our specific time frame. That makes sense so far?
yeah,
Cool. All option contracts include two things. So whenever you're getting into the platform, you're looking to the options chain, you will always have to select the strike price and the expiration date. And you're usually going to select the expiration date before you select the strike price, because you have to click which expiration to first get into. Then when you click the expiration, it'll open up the list of the strike
yeah.
prices, and then you choose a strike price from
Yeah, you
there.
make sure you have a good strike price before you even choose the expiration date, though, right? Or do you?
It actually, it depends, and that'll make more sense as we get deeper into it. It'll make sense, and I'll bring it back up. I'll bring this moment back up when it makes
Yeah,
sense too. So there's a price attached to all options, and that price is called premium. So whenever you hear someone say, "I'm selling premium," or whatever it is, like they're just talking about the value of the option. That's the premium of the option. The premium is the cost of the option. So you'll hear that term thrown around all the time. I collected this much in premium. I collected this much in credit, whatever. The
So
premium,
is that a
yeah,
specific number, or is it like the value overall? Like,
the
will it be?
value overall. So it's not a
Okay,
specific number. It's
I
like
didn't.
if let's say I'm selling this call spread, um, let's say it's going for $1.20. That's the premium that I can sell it for. Let's say it's going for $1.80. It's still called the premium. Let's say it's
So
going
just
for $3.
what
It's just the
literally what you
premium.
could sell it for. Okay.
Exactly. It's
Mhm.
the value
So
of
actually,
that.
okay.
Yeah. So then you might even hear some people say, "Oh, well, I like this trade. I want to sell the 460s. I'm just not collecting enough premium." That's
Hmm.
what they're saying. I'm not collecting enough premium, or they might say, "I'm not collecting enough credit." And again, I'll keep tying these terms back together as we keep going on, so you kind of make the connection.
Yeah.
Because I would say with options, the terminology is probably the part that throws most people off. I recognize it's 2 minutes till. I'm going to get through this last slide, and then we'll hop into the market and
Yeah.
check out what's going on. I'm probably going to be on Twitter at the same time, so I can kind of see what exact decision they made too. So, option premium. Now the premium of an option is what the contract is currently worth. Oh wow, I explained that without realizing this slide was coming. So there are three things that influence the value of an option.